Hey there, welcome back to the channel. If you're new here, hit that subscribe button so you don't miss out on more personal finance tips. Today, we're diving into one of the easiest, most efficient ways to invest your money index funds. Whether you're a complete beginner or just curious about how index funds work, this video will break it all down for you. So, let's get started. First off, let's talk about what an index fund is and why it might be a good choice for your investment portfolio. Simply put, an index fund is a type of mutual fund or exchange-traded fund, or ETF, that tracks a specific index in the stock market, like the S&P 500, which tracks the 500 biggest companies in the US. This means the fund's performance mirrors that of the index it follows. Now you might be thinking, what's an index? Think of an index like a collection of stocks that represent a particular part of the market. It's a way to measure the performance of a group of stocks. For example, the S&P 500, as I mentioned, includes 500 of the largest publicly traded U.S. companies, giving you a broad overview of how the U.S. stock market is performing. This makes it a great indicator of the overall market health. When you invest in an index fund, you're essentially buying a tiny piece of all the companies included in that index. This diversification helps spread out your risk. So, if the S&P 500 goes up, your investment goes up too. This correlation makes it easier to understand how your investment is performing. And the best part is, you don't need to be a stock market expert to get started. Index funds are designed to be simple and accessible for everyone. Instead of trying to pick individual stocks, which can be risky and time-consuming, index funds offer a hands-off approach to investing. This can save you a lot of stress and effort. You're basically letting the index do the work for you. It's like investing on autopilot. This automated approach can be very appealing for busy individuals. Now, there are tons of different index funds out there, each tracking a different index. This variety allows you to tailor your investments to your preferences. You've got index funds that focus on specific sectors like technology or healthcare, and others that track international markets. This means you can diversify not just within the US but globally as well. This means you can choose index funds that align with your investment goals and risk tolerance. Whether you're looking for growth or stability, there's likely an index fund for you. But here's the thing. Index funds aren't just some random investment strategy. They're based on a solid foundation of data and research. They're backed by decades of data and have consistently outperformed many actively managed funds. This historical performance gives investors confidence. This is because actively managed funds, where a fund manager tries to pick winning stocks, often come with higher fees that can eat into your returns. These fees can significantly impact your overall gains. With index funds, you're keeping it simple and keeping more of your money working for you. Lower fees mean more of your investment stays invested. It's a long-term investment strategy that has proven itself time and time again. By staying invested, you can benefit from the market's overall growth over the years. Reason number 1, diversification. Instead of putting all your eggs in one basket, which can be risky, index funds let you invest in a whole bunch of companies at once, spreading your risk. This reduces your risk because if one company's stock price drops, the other stocks in the index may help balance things out, providing a cushion. Imagine this. You're super excited about a new tech company and decide to invest all your money in it, hoping for big returns. The company seems promising, but then, bam, something unexpected happens. Maybe a product launch fails or a competitor emerges, and the company's stock plummets, leaving you in a tough spot. Suddenly, your entire investment is at risk and you could lose a significant amount of money. That's the danger of putting all your eggs in one basket. It's a risky move that can lead to substantial losses. But with index funds, you're spreading your investments across hundreds, even thousands of companies, which helps mitigate that risk. So if one company takes a hit, it's not going to make or break your entire portfolio. Your investments are more secure. Think of it like this. You're building a safety net for your investments, ensuring they are protected. By diversifying across different companies, sectors, and even countries, you're creating a more resilient portfolio that can weather market ups and downs, providing stability. Now, diversification doesn't mean you'll never experience losses. It's not a foolproof strategy. The stock market, by nature, goes through cycles of growth and decline. It's a natural part of investing. But by spreading your risk, you're reducing the impact of those fluctuations on your overall investments, making your portfolio more robust. It's like having a diversified investment portfolio is like having a balanced diet. Both are essential for long-term health. You wouldn't just eat one type of food, right? That would be unhealthy. You need a variety of nutrients to stay healthy. Similarly, your investments need diversity. Similarly, your investment portfolio needs a mix of different assets to stay healthy and grow over time, ensuring long-term success. And the beauty of index funds is that they make diversification incredibly easy. With minimal effort, you can achieve a well-balanced portfolio. With a single investment, you're instantly gaining exposure to a wide range of companies, making it a perfect choice for both beginner and experienced investors. It's a smart move for anyone looking to build a strong financial future. Chapter 3. Low cost. Keep more of your money. Reason number 2, low cost. This is one of the most compelling reasons to consider index funds for your investment portfolio. Index funds usually have low management fees, which can be a game changer for your investment returns. Why? Because they aren't actively managed by a fund manager, which means fewer overhead costs. They just track an index, which means lower costs for you as an investor. This simplicity is what makes them so cost-effective. Now you might be wondering, what's the big deal about fees? Why should I care about them? Well, let me tell you, even small fees can eat into your returns over time, especially when you're investing for the long haul. The impact can be surprisingly large. Think of it like this. Every dollar you pay in fees is a dollar that's not working for you. It's essentially lost potential. It's like paying rent on your money instead of owning it outright. You want your money to be free to grow, not tied down by fees. Actively managed funds, where a fund manager is constantly buying and selling stocks, often come with high fees to cover their salaries and research costs. These costs can add up quickly. And here's the kicker. There's no guarantee that these actively managed funds will outperform the market. In fact, many of them don't. Index funds, on the other hand, are passively managed, meaning they simply track a specific index. This approach is straightforward and effective. This passive approach keeps costs low because there's no need for a team of analysts or expensive trading strategies. It's a lean operation. And the best part is, these low fees can make a huge difference in your long-term returns. The savings can be substantial. Let's say you invest $10,000 and earn an average annual return of 7%. Over time, this can grow significantly. If you're paying a 1% fee, you'll end up with around $70,000 after 30 years. That's a decent return, but it could be better. But if you invest in an index fund with a 0.1% fee, you'll have over $76,000. That's an extra $6,000 just from saving on fees. Imagine what you could do with that extra money. That's the power of compounding returns combined with low costs. It's a powerful combination that can significantly boost your wealth. Over time, even small differences in fees can add up to a significant amount of money. It's a difference you will definitely feel. So when it comes to investing, remember this. Keep it simple, keep it low cost, and let time work its magic. Patience and low fees are your best friends. Index funds offer a fantastic way to do just that. They are a smart, efficient, and cost-effective way to grow your wealth over time. If you're ready to start investing in index funds, remember, the earlier you start, the better. Let me know in the comments if you have any questions, and I'll be happy to help. Don't forget to hit that like button if you found this video helpful, and subscribe for more tips on investing and personal finance. Thanks for watching, and happy investing.